Hello, welcome back. I think this video is probably going to be useful to many people, so I'd definitely recommend to watch it through the end because I think there's gonna be some very interesting information in this one. A subscriber of our channel actually asked a very interesting question. The question was how do we value a company that is not making money? A company that is not profitable, it like loses net income every year or every quarter. How do we value that company? Now, whenever we are looking at companies that are losing money, there is always more risk than a company that is making money, obviously. And so, if we are actually willing to buy a company of that sort, regardless of how good we think the company is, we need to make sure that we understand that we are taking more risk than normal. It is always taking more risk than a company that's actually making money if we decide to buy stock of a company that's not making money. Again, regardless of what you think about the company, like I personally like Fiverr myself a lot, and I think that they potentially will be doing better in the future and they will eventually become profitable. Yet I bear more risk taking stock in Fiverr or Fever, however you want to call it. I'm not sure what the actual pronunciation is. I'm taking more risk on this stock than actually buying a stock that is profitable right now. I don't know, like Intel, for example, or even one that is way overpriced but still profitable. There is more risk here because the company is unprofitable. Now, once we understand that, we may be like, okay, I understand that and I'm willing to take the risk and invest a little bit of my portfolio to this kind of companies, potentially trying to catch the next Amazon. You need to realize, of course, that for every one Amazon that has happened in this world, there have been a thousand others that have actually gone bust. And this is what typically tends to happen with companies that are not making money. Not the opposite. They don't become profitable. Most of them actually go broke. So that's important to understand. And for many companies have actually had the financials that Amazon had at some point. Yet it's only Amazon that achieved the greatness that it has achieved today. And this is a multi-factor thing that will not be happening with the vast majority of companies. Actually, the opposite scenario will be playing out. And this is why you're having way more risk taking on this kind of company here that's losing tons of money. Now, if we're willing to do that, how do we go about valuing a company of that sort? Now, typically, I like to use three different methods. I'll start from the worst one and I will move to the better one. And so pretty much it's gonna be the worst one to start, and then we're gonna be moving to a little bit of a better one, and then the best one. The worst method would probably be the price to sales ratio. Now, with the price to sales ratio, what is that? You can actually see that also in the help here. It kind of shows the relationship between the price of the stock and the revenue, the sales that the company is making. And so, since we don't have a positive net income, we do have positive revenue because we have sales. We can actually understand how expensive the stock price is when we compare it to the revenue that the company is generating. It's almost like the price to earnings ratio, but it's using the revenue instead. And so you will see here that it's 6.75. Now, typically, we would want something between 1 and 2, as you see here. Anything below 1 is excellent as well. Of course, this has to do a lot with the industry as well and the sector. And so you may want to compare it with other industries, but this can kind of give you a first glance at how expensive the company could be in terms of its revenue here. So yeah, you can definitely compare it with other companies of the same industry and kind of see how far they are from each other and all that. Now, this can be a little bit of a deceiving method, the price to sales ratio. And this is why there is another one which is a little bit better. It's the EV to Ebitda method. And this one is a little bit more complex. And this is why I wanted to make a completely separate PowerPoint and actually explain what that is. And so let's jump to this one. I actually created these slides here because I think it's much easier to describe it using this than actually start talking, and it may not make a lot of sense. So, enterprise value to EBITDA is what we will try to use next. And I will explain what it is and why we're using it. Now, you can use this with profitable companies as well, but for non-profitable companies, it makes a ton of sense because it uses EBITDA, which extracts a lot of the expenses. Now, what is the enterprise value of a company? A company's value, you may be thinking about it like its market cap. After all, you are like, okay, we're having, let's say, 10 million shares, and we multiply that to the value of the stock price, right? So we get the value of the company. Well, not really, because the company also has some other things like debt and cash that you have to account for. And this is where the enterprise value comes into play. And you can see here that I have appended the boring theory, which describes the enterprise value as the measure of a company's total value, and it is the market cap plus the net debt, which is total debt minus the cash position of the company. That sounds theoretical and nice, but what is that really, and why do we need that? Why not just use the market cap? And so here I have a simple example that I think it's gonna serve to understand better why we use a value like enterprise value. So let's say that you want to buy a company which has 10 outstanding shares worth $1 each, right? So the market cap of that company is what? $10. Now the company also has $3 in debt and also has $5 in cash. So a company has cash reserves as well, right? They needed to pay some inventory and things of that sort. And they also have debt because companies grow with debt, and actually some of the returns that you see, so some of the investment returns that you see are actually based off of debt, because debt is a way to finance operations and finance the company, generally speaking, and make money from that debt. So this company has a $10 market cap, $3 in debt, and $5 in cash. And so assuming that every investor in that company is actually willing to sell their shares to you at that price, which is typically what you see for acquisitions happening at higher prices, because the investors have to vote yes. And so they vote yes when you are willing to pay more. So this is why large investors pay more. Now let's say that you can't buy the whole company, everybody has agreed, and you can buy it for $10, the market cap pretty much. So when you buy the company, of course, now you own the cash and the debt of that company as well. After all, you bought 100% of it. And so here's what happened. The company had $5 in cash and $3 in debt. And so what you can do is you can use these $3 of cash reserves to pay off the debt. And so now the company has zero debt and a remainder of $2 after all debts are paid for. And so now you can actually pocket yourself this extra $2. After all, it's your company, right? So you can pay yourself a dividend of $2. So you pocketed these $2 that you actually never really paid for them, right? They were in the repository of the company. And so you ended up paying 10 minus 2, practically speaking. Yet you still purchased the whole company. So let's examine the enterprise value, and now that will serve to understand what it is much, much better. Because the market cap was $10, the total debt was $5, the cash was $3. So what is the enterprise value of the company? It is $8, which is what you actually paid, right? Okay, so for Fiverr or Fiverr, however you want to call it, I have the values just here, because in the stock tool I haven't added the enterprise value yet. This is a value that I long wanted to add it, but I don't want to force it into the tool, because it doesn't really fit the current layout. The current layout has like values that are like that have like some sort of predetermined ratios that are nice and things of that sort, while the EV is more like an informative value. I will be adding it, of course, for sure, but I wanna think it through a little bit and think where it should be on the tool, because again, it probably doesn't really fit on the main page. Now the EV of Fiverr, if you can find it for 2021, it was to 2.6 billion. And of course this changes with the date because it includes the market cap, right? So the market cap is affected by the stock price. Now the 2021 EBITDA for the same company, Fiverr, in the same period, of course, was minus 57.98 billion. You can find that on the tool as well. And so if we calculate the multiple of our enterprise value when you compare it to our EBITDA, it is minus 45.42. So it is negative. And why are we using EBITDA? Let's go back to our tool. Let's take a look at the financial statements of the company, and let's take a look at the income statement here. And that is the income statement of Fiverr. And if you see here, we have the revenue, we have the gross profit, and then if you go down, we have our net income. Now our net income is minus 65, But if you go higher, you are seeing that the EBITDA is minus 57.98 is what I told you about earlier. Why? Because the net income is actually extracting taxes, interest, taxes, depreciation, and amortization, the values from EBITDA, because EBITDA is earnings before interest, taxes, depreciation, and amortization. So it actually adds these values back. And so this is why this value is actually better to use for a company that's not making earnings, because that's not making net income, that is, when we're talking about profit, because it extracts a lot of the expenses. It extracts interest, taxes, depreciation, amortization. And as you can understand, if after we're extracting all these values, we're still getting a negative value, a negative EBITDA, the company is at an even worse position than you originally thought it would be. Because now the company is not making any earnings. It's actually losing money before all of these expenses, which is a very, very bad thing to see. Okay, hope that makes a little bit of sense. Now, typically, we do want to have a little bit of a positive EV to EBITDA, even though it can be high. But in this situation, we're looking at a negative one. And I have also appended the price to sales ratio here for reference. This is the one that I talked about earlier, 6.75. Now we use this method, we use these two methods already, and we are seeing that the company is probably a little bit overvalued. Again, we wanted 1 to 2 here, even for a non-profitable company. And the EBITDA is basically unrecognizable. We cannot even deduce what we should be willing to pay here. It doesn't make any sense. So now we are resorting to our last method, which I think it's the best really, and that is the discounted cash flow model. And I'm not just saying, it's not me that's saying it's the best method really. It's generally speaking considered to be probably the best method to use for this kind of case. And the reason for this is that we can project what the company is going to be doing in the future and project positive cash flows and positive net income. Again, we are taking risk doing that because we don't know whether that's going to happen or not. But that's the case with non-profitable companies. They are not making money, so we have to project a time in which they will be making money. Otherwise, it doesn't make sense. So, the revenue growth of the company, let's just say that the company is hitting it out of the park, 20, 30, and 40%. After all, it's a company that's growing massively. So let's go with massive revenue growth. Here, we're looking at a company that we want it to grow massively, at least, because otherwise, how are they going to be profitable, right? They need to be growing nicely. And they have been growing nicely, and so we can potentially see them growing at this rate. Now, the net income margins, of course, are all negative. They are negative because the company hasn't been making money. And you see that they are all over the place. This is net income divided by revenue. They are all over the place. So what can we use here? And this is where we have to be confident or positive that the company will achieve profitability. How much in terms of profitability? Let's just say 10%. Meaning that of every $100 in revenue, in sales that they're making, they get to keep $10 in profit is what that means, this 10%. $10 in net income. That is not even EBITDA, this is net income. This is after all the expenses are deducted, which is what we want to see, of course. So let's just say that 10 happens, or 20 happens, or 30 happens in our high scenario here, our high projections scenario. Now, what about the free cash flow? Now, the free cash flow margin, you are seeing it positive here, but it's not really positive. It becomes positive because it's the relationship between the net income and it's the relationship between the free cash flow and the net income. And if both of these are negative, as you see here, for example, this becomes positive. But practically speaking, it's a negative value, has a negative sentiment, really. So again, these values are generally speaking negative. And we cannot really use this as an average. The company is not making money and free cash flow, really. And so what are we going to do? Again, you may be seeing some positive free cash flow, but remember this happens because of depreciation, amortization added back, and also to the free cash flow statement, the cash flow statement, and also some cash-based compensation. And this is why it becomes positive. It's not really a positive value from the company's operations. And so the free cash flow margin that we're going to be using is something that's kind of rather typical for a company. And so we're going to go with something like 80, 90, and 100. And 13% is the annual return that I want to be making out of any single stock. Now, for this one, I would probably go 15 because there's much more risk. I will try both so that we have it for a scenario here. As you see, I have actually taken into account that the company will potentially at some point reach profitability, and rather soon, because this is a 5-year revenue 5-year discounted cash flow model, really. So the projections are for the next 5 years. And so if that doesn't happen in the next 5 years, what are we actually even looking at? We're looking at a company that's losing money, so it makes no sense to buy it. That's pretty much the end of it. So if the company becomes profitable and achieves this kind of numbers in the next few years, then we are looking at this. We're looking at this at a low estimate of $19 as our max price to pay today, our medium one at 64, our high one at 151, and the current price being at 54, which means that if these things were to come true, then we're looking at a company that's worthwhile buying. But these are very risky assumptions, of course. Let's just say that we won't, actually let me leave the annual return at 13%, I think that's fair, but let's just say that we are less aggressive here. Let's just say that the company becomes just marginally net income positive here, makes just a little bit of net income out of the revenue. And now here, you see something that probably makes a little bit more sense based on what the company is currently doing. Again, because the company is not making any margins, they are not making any profit. And so now we're going close to zero here, and this is where we're getting much lower values, as you can understand. Now the revenue growth could be achieved, but the net income margin is another thing, and it's much important. And it's going to be tough to go from losing money to achieving 10% or 15% of net income margin. And this is why you're seeing this kind of values. And so this is what I would do for assessing this kind of company and see whether I would like to buy it. And if in my projections I would see something like green over here all over the place, then I could have a case, or maybe even for the medium ones, meaning that the company would be trading at a much lower valuation than what it is right now. And again, that would be based off of how much risk I would be willing to take. I could say that I'm expecting the company to grow at 5, 7, and 8 in terms of net income margin, but if I'm willing to accept that, then I'm allowing myself to get a 15% annual return at least. And so I'm discounting my cash flow model at 15% instead, because I have more risk and I want to be making more money. And if I hit calculate now, then you see we're getting a different set of values that again make a ton of sense. But again, they presuppose the fact that the company will be making at least 5% for this one the next 5 years. So this is what I wanted to talk about in terms of how to analyze a company that is not making money. And if you are willing to take some risk, then at least make sure that you are not paying a lot. Make sure that you are paying too little, if possible, if you are willing to take this kind of risk of potentially losing some money and having a company that may not reach profitability at some point. Thank you for watching the video. A little bit lengthy, this one. I hope you enjoyed it. And of course, I'm not taking you through the rest metrics here, because you know about these. Other things like outstanding shares is a bad thing here. But we have talked about this in much detail in previous videos. This was mostly a video to talk about how to value non-profitable companies. Okay, so again, thank you for watching this one. Please leave a like if you did enjoy this video and it helps you a little bit. And remember to subscribe tomorrow, because today is Sunday. Tomorrow I'm opening up this too for Patreons, and I will let you know how to get access. I'm gonna be making a dedicated video for this, and so please subscribe, be around for when that happens. I'd love to see you in our tool and grow our community there. Thank you for watching this one again. Have an awesome Sunday. Bye bye.